So here is a roadmap of the key learning objectives. What are incremental cash flows, after-tax cash flows, relevant cash flows? How do I do these on a standalone basis? What are the three pro forma financial statements that we use? Basically simple, the income statement, the balance sheet, and the statement of cash flows that we learned in session 2. And what are some alternative definitions for OCF? Again, we can use those three new methods if there's no interest expense. What are special cases of discounted cash flow? When can I use these methods again in some special cases, like buying a large inventory management system, for instance, in which there's no sales involved? How do we handle that? So let's talk about some of these new methods for looking at project cash flows. What is a project cash flow? It's the effect of taking on a project, changing the firm's overall position in cash flows today and in the future. And I need to decide whether the changes will add value to the firm. If I take on this project, will we be adding value? We want to look at relevant cash flows that change the firm's overall future cash flow position as a result of taking on the project. We want to look at incremental cash flows each and every year, changes in the firm future cash flow values as a result of taking on the project. We want to do the analysis on a standalone principle. What does that mean? We don't want to add together your new project with your existing project. If you're adding a 11th bakery in Brooklyn, you don't want to add it to the first 10. You want to let that 11th bakery stand on its own, treat it as a mini firm isolated from your existing projects. Let it stand on its own 2 feet.